All right. Guys, bear with us. We're trying to get everybody on board. And I've got NASDAQ 100 and the NASDAQ futures and ES futures on the screen in front of you while we're waiting. All right. Outstanding. Were you putting this on Reddit too? Might as well. I'm not going to share anything I shouldn't. All right. Because I got to get to the workshop. We just had a mean reversion on the 5 minute, guys. Anybody on with me? I don't see any chat, so. One second. I got one person on. That's all I can see in my YouTube studio. All right. So I will not be able to see. Yeah, I just can't see to answer questions in on YouTube. So if there are any, ITG folks can hit me up in the workshop. All right. You got to let me know when we got enough people. Because I have no idea. Baby cakes. I like it. Who else we got? Can we get a roll call in? Let's get us a roll call here. I can't see any of that. which is weird. I guess because I'm streaming. Oh, mercy, Chipmunk. Welcome to the club, man. Great community. I'll share more as more people get here, but just, man, take it slow. DM or AR or just post them in workshops is fine. I want to make it, we're going to go through everything as fast as we can. What up, Red Leg? I tried to get my wife to go to Red Leg Brewery the other night. Hey, Miss Yukon. Good seeing you. Hadn't talked to you in a little bit. Guys, my screen, if it's sharing, is that you should see the 5-minute. This is that script. I'm still working out some kinks from the TradeStation script. No, not necessarily, Chipmunk. I use IB. A lot of people use Thinkorswim. Again, that'd be a great question to ask in General Lounge. Whenever. I mean, there's no rush. The reason I use Interactive Brokers is because I use them and I ran my hedge fund with them. And their ability, they're the only broker as of today that allows you to trade SPX in another 15 minutes. You're going to be able to trade SPX on Interactive Brokers, whereas the others are going to make you wait till tomorrow morning is open. But that said, again, the amount of value it provides being able to trade overnight, that can be negated easily with futures options, on ES. If you're looking at the chart now, we have weekly buy trigger. And again, going to ES, and I'm going to try to make it, I'm trying not to jump all over the place, but just as we get started, the first thing that we do in the PVI system is we want to identify where our weekly supply and demand zones are. And so that goes back to just our original PVI. You can see we don't have, I don't know where weekly supply demand box is. But we had a member that marked all of his 2024, a call debit spread 5 wide, a put debit spread 5 wide outside the box. The amount of times we finish outside the box, the weekly supply demand box, it's about 93%, 94% that we close outside of the box. So trading a long call debit spread and a long put debit spread, the system I use, I try to get a 5 wide for $1.25. Difficult, but can be done. Easier on ES than it is on SPX because ES opens, the options market opens a lot earlier, 2 hours earlier. As far as, 5 wide for $1.25 up here, 5 wide for $1.25 here. If we finish outside it, you're going to get paid $5. So 125 and 125 is 250, and you get paid $5. Well, put 250 in the slot machine and get a $5 win, and you're going to win 90% of the time. That's a good system. It's even a better system because you're holding a 5 wide here and a 5 wide here, so that if the PVI is challenged, you have an embedded hedge in your trade. So that's there. So again, let's go back to the start real quick. I'm not going to spend an hour talking through PVI. There's a video. It's posted in Reddit. It's on YouTube. We talked about it. This last year, these were our PVI ranges, and this was our only breach. And it was on a 4-day week, which everyone in ITG knows 4-day weeks are infamous for breaking models. We breached Labor Day. That was the only breach in the entire year. And guys, this is up here. Here were 3 breaches in 20. Ooh, I didn't just do that. In 2023, Here was an early one in 2023. And, I mean, these guys have been with me, and we go all the way back to 2021, and PVI's on the system. I post them every weekend. We post them. Here they are, free at last for everyone in the world. Anybody that wants to tune into our YouTube. Here's our PVI for this next week, and I'm going to show you, more than just that. But we're going through the models and looking at the models and running the algorithms, and so this is how the process works. Real quick, here's our ranges for this week, and so SPX. Here's PVI. 57.34, 57.34. PVI high, 61.22. 2 stars, meaning that's an all-time high, 52-week high. 61.22. Here was our previous close last week. What's important on this, we post, is that we also post this is an algorithm that I run. This is an algorithm that we run. Matter of fact, this algorithm was made into a script. This is your PWG script, which has your weekly supply, weekly demand levels on it. Then baseline is an option model. It's an option algorithm that we run. So these 3 are separate to this one. These 3 help us compute and figure out this one. And we're going to kind of go through that. I'm not going to go into detail and do some damn doctoral class on PVI system, the who, what, where, when, why. Especially when there's people asking, what's an option? How do I trade futures? How do I trade, whatever. This low extreme, high extreme, it's not super important by itself. This is just telling us that the PWG 5791 should be further outside than baseline. That is not accurate. I got to go back and recheck this one. I might have copied, pasted wrong. But all this goes through and tells me that the blue is telling me the option premium have priced in most of the moves. Big change here versus last week. Like, holy hell. Last week is a buy a straddle week. At the money straddle for the week because option premiums are not priced in. Baseline low was 58.09. PWG low was 57.59. So a full 60 points here, right? Or 50 points here, lower. 61.82, 61.32. This is the options market. This is what volatility was saying we were getting to. So how does that really look? Again, it's kind of skewy, but I just do it because I want to look down here. I want to have a quick glance to see, hey, are we slanted toward options? Are we slanted towards volatility? Do the option premiums cover in general the market's expected move for this coming week? Well, what is the market's expected move? I don't know. I've given you guys these. We have four different levels here in front of us. Okay, I'm going to post all this stuff in Reddit, so you're not going to have to worry about it. Right? First week's going to be a gimme. But when we look at all these different models, they're all incorporated. Those 4 are going to be incorporated into. Oops, I almost screwed up. Help me. Hang on, folk. Incorporated right here. So 61.22, I think, was PVI. And it's inside this big ass tower. So be careful. Now, I don't change PVI because I know what this is telling me. But this tells me that if you sell 61.22 calls, there are 5. There's 26 models in this. This is what I call the SPX model profile, model range profile. And all this is there's one model telling us this is the range for SPX this week. Here to probably here. This one out here, it's an outlier. This one down here, it's an outlier. This is 2 times the expected move, and we're not going there. This is 2 times the expected move, and we're not going there. But you got to be aware that there's 5 of 26 models that are saying we might hit 61.25. So I like to draw on things. Most of us are visual learners. And so all I would tell everybody is, from workshop-wise, let's think about this. If I'm trading to the high side, okay, I got one little blip right here, and then I got a cluster of ranges right here. 2, 3, 4, 5. 5 ranges that are saying we're going to this zone. 625 to 655. There's a really good chance we're going to go up there. So if I'm a delta trader, I want to be long right here. I want to be long the 6,000 calls. And then if I'm a theta trader, I want to be way outside here, right? I want to be in BFE / Timbuktu, out in the middle of no man's land, because I want to go collect my pennies. I want to pick up my pennies, my nickels, my dimes, my quarters. Now, when you get inside this zone, this level and this level, now you're going to have some clinch, right? You're going to get some ass workout, but you're not going to collect some quarters and nickels. You're going to get $1. You're going to get some dollar bills. Matter of fact, you're going to get about $4 bills right here. And you're going to get about $2 bills right here. Okay? The more you want to make, the more aggressive you're going to be. But if you put on a tight call debit spread right here, and then you sell premium over here to pay for it, and we stop somewhere between here and here, this is a win on your debit spread and a win on your credit spread, and this is a double winner here. And that's how the market works. That's how PWG works. So when you look at this, and I post this, I'm going to do it once a month in Reddit. ITG guys get it every Saturday morning, Saturday afternoon. I'll post all the data, but there is a very clear disconnect between these clusters. There's 3 different clusters here, and that doesn't count. Now, if there's ever another model that attaches itself to 2 times the expected move, look out, because we might be in trouble. Now, that's the high side. The low side, well, we got 3 models here. We got 3 models here, and then we got 7 models here. Well, what's at 57.50? This is right here. We're closing the gap from the election. So just understanding that there's 2 huge towers that we need to be aware of, that if the market runs past this node to the upside, just scroll down the middle, and it's about 60.80. If SPX goes above 60.80, there's a good chance it's going to run all the way to 61.30. There just is. And the reason why is we get into Vanna, Gamma, we get into Gamma bombs where all these folks right here are going to get run over if they're trying to short. And all these ranges get busted. And again, it's just a visual profile to look at and go, okay, well, do I need to know which models are telling us which ones are the 7 of 26 models that are telling us we could go all the way down to 57.50 this week? You don't need to know why. Matter of fact, I didn't even know why for probably 12 years. And it hadn't been but the last 3 years that one of our members has helped me take a huge ass program, run through Excel, as painful as can be. Guys, remember I was doing this in 2003. There was no Python, C++, or any of that other stuff. And we've broken it down into bits and pieces that I knew were part of the major PVI algorithm. And so because of it, we can go through and I can tell you which one of these 5, which one each represents. But if you just go and look at 6122, it's in here. 6111, it's one of these 2. 6093, it's in here. 6093, it's in here. 6107, it's in the same one. 6107's right here. So again, you know where it is. It's incorporated in. Again, there's just 26 models. I don't have the time and the capacity to run it on ES, SPX. I don't even run it much anymore on NDX. I still have them. I don't do a lot with NDX anymore because my consulting agreement with the NDX guys is up, and they don't pay me. So fuck, I'm not. Excuse my language. I'm not going to sit there and do 4 hours of work for a group of hedge fund guys that are managing, $1.3 billion, and they ain't paying me. Screw that, and the horse they rode in on. But that just gives you an idea of the model profile. This gives you an idea of where the algorithms are. 5734, 5773, 5791, 5777. Well, why is auto 73, baseline 77, PWG at 91? Why is PVI way down here? Aha, because there's more data than just right here. And you start looking at these, how many of these don't have 5750? And there were 7 models that are telling us we might go all the way down to 5750. And this model, again, this is below the big tower on the top side. That was 6125. So just knowing where those models are, am I going to sell the 6120s, or am I going to sell 6125s, or am I going to sell 6130s? I'm going to trade more conservative. Why? It's the second week of the year. Why lose money? Why risk money? For an extra 60 cents, you got 52 weeks to go turn a profit. Don't play too aggressive. Down here, again, this is what the models show. And so then we start to get into market structure. And that's where I want to spend a big chunk of time, because our ITG members want to know, we're at crossroads. What are we going to do? What are we expecting here? So first thing for ITG folks, again, look over here. 21 EMA, those are my orange dots. 50 simple, 100 simple, 200 simple. Can you have 50 and 100 and 200 exponential? You can. The only reason I use this is because I kind of had to use it when I was running a portfolio, because our portfolio was mimicking mutual funds, and mutual funds typically were using the 50 and the 200-day simple moving averages. The others matter just the same. Just create your rules. Here's the 50 simple on SPX at 59.47. Rounded up 59.50. This is just a bird's eye view to see where we are. 21 EMA, 50 simple, 100 simple, 200. Red, white, blue, they're stacked. They've been stacked. For how long? A long time. Right here. Here's the crossover in December of 23. Over a year ago. When they're stacked and it's red, white, and blue, man, you are long America. Did we fail the 50? Yep. Right to the 100. Did we fail the 50? Yep. Right to the 100. Did we fail there? Yep. Did we make it to the 200? Nope. Was the 200 still positive? Yep. Are people still buying the dip? Institutions are. And really, what matters more than institutions? Not your 5 contracts. And so again, just in concept, if the 50's above the 100's above the 200, you should not be in the, I'm going to short the market because we're going to crash. I don't care what on God's green earth is going on. Now, did we have this big move in July down to the August 1st? Yep. Did we have one in April? Yep. Did we have another one in September? Yep. Did we have another one in November, end of October? Yep. Are we in another one right now? Yep. Do we know where it's going to end? Nope. Do we cancel all our holdings? Nope. Is the 50 and is the 100 still positive? Yep. Is it still above the 200? Yep. If we go down here and we get red cross in white or red cross in blue, and we get a death cross in the 50 and the 200-day moving average, go back to 2022, you will have more time than you know what to do with to get short. You do not have to time the top. That is the biggest mistake traders do. Now, better than the simple moving averages and the 21 exponential, the white lines are our weekly supply demand on our PWG. We don't have them for this week yet. But last week's supply is a virgin. We never hit it. We never hit this one either. And we're going to talk about this one because this one is the all-time high supply, weekly supply. We didn't hit this one until we did. We hadn't hit this one maybe until we do. This becomes your upside target. Gravity point A. Now, just like the moving averages, 50, 100, 200, are they stacked? Yes. Well, are our gravity points stacked? Alpha, Bravo, Charlie. Yep. A is over B, B is over C, and A, B, and C are all positive slopes. So, I go over here, I grab me a nice little horizontal ray, and I put a line there. It don't matter, we'll make it white. I put it right in the middle of that dot, and I'm going to leave it there for the whole week because I want to see how these gravity points start moving. The reason why I say that is I often, as all the ITG members should do, is go look at where we were right here. Right here on December 6th. Is A above B? Yes. Is B above C? No. Is price above, are they all positive? Yes. When you've got two of the three together, where do you think the magnet is? Where's the polarization in the market? When two of the three are together. At the two of the three. When they line up with the 21 EMA, this just tells you right here, we're above the top gravity point. They're all positive, but there's a good chance we're going to mean revert back towards here. Fast forward or hit play and watch the gravity points. B is crossing C. We came down, and now we've got cross. Is at the bottom. We didn't make a higher high. As soon as we make a higher high, we're going to A, and boom. There we push through all of them, and now we come down. Now, that gap wasn't there. That gap was all the way up here. I have moved the box of the gap to show you how much of the election gap is yet to be filled. And it's right here. I just slid it over because I don't want to screw up, Thursday's price action, Thursday's lows. So what do we got down here? We got the election gap we have not filled since the 5th of November. We also got the 100-period simple moving average that is positive. Okay? So we've got a lot, and this is 5,800, and this is 5,780, full of the gap. Go back to this weekly demand here, 63. Somewhere in here is 5,750, and that's where the big 7 models are telling us SPX could drop to. Now, if we do go close this gap and we wick down to 750, I will tell every person that's listening, if we drop down to 750 and the market responds favorably, which means you start seeing green volume from 750 or green volume from 5780, guys, you better buy some calls. You better buy some calls. Because in the event that we close that, all these guys that were short, they're still trapped. As soon as the market gives them an exit, they are going to take that freaking exit. They're knocking over your fucking grandma. They are getting out the door. All the shorters are. Right? Because they literally, right here, this is what we were talking about earlier. The shorters from before November that knew what the election outcome, the folks that were wrong, their sphincters have eaten their entire body right here. Like they're black hole. As soon as we get down here and they can break even, they are getting out. They are freaking exiting as fast. I mean, it's pull the fire alarm and run like hell and push the wheelchair dude down the stairs. I mean, it's going to be mass chaos. Then you look at, is the market going to go down here? Well, we also got this 6,000 zone, which is last week's supply. It's also the 21 EMA that is turning negative. What happens when we slice through the 21 EMA? We come back and retest it, and we came back and retested it last week. It was messy because what? Because we've had shortened holiday weeks with no volume. Now, is there a chance we could get back up to this 6,000 zone, touch the 21 EMA, kiss it goodbye, and then go close the gap? Yep. Is there a chance we go close the gap first? Yep. Is there a chance we go through the 21 and we go all the way up to 60.50 or maybe 6,100? Yep. You can do anything. We don't know what's going to happen. So our job is not to predict. Our job is to script and author if-then statements. What's if-then? If we get above the 121, the 21 EMA on the daily, If we get above weekly supply last week, I don't know where the weekly supply is for tomorrow. If we get above that, you do not short because we're going to here, right? When they turn this on, I mean, this is a badass magnet right here that is going to pull the market, right? How many people do you think are going to buy when we get back above the 50-day moving average? Let me erase that. How many institutions, how many mutual funds are going to get long in January when we get back above a still positive slope 50-day moving average? All of them. In prospectus, it used to be back in the 90s, in your prospectus, you used to go through, and in the event that we were below the 50 and the 200-day moving average, and this was not a positive sloping average, our prospectus as a portfolio manager allowed us to raise cash. Why? Because if the 200-day moving average is going negative, it is dropping, then prices underneath it, it allowed us to build cash in our portfolios. Can't do that anymore. So now some of these long-only funds, guess what happens when we get down here? They got to go find the most, the stocks that are going to drop the least. They still have to stay invested. They just want to invest their money in the areas that are going to experience the least amount of drawdown. Well, do you think that's the Russell 2000? Do you think that's the NASDAQ 100? Do you think it's going to be the Magnificent Seven or the Tech Generals? Heck no. And so if we do get down below there, those are the ones that all the retail guys say, hey, man, if I could have just bought in August, I could have bought, they were talking about it earlier today. If I just bought Fartcoin, I could have bought a Lambo. Okay. If, coulda, shoulda, woulda, all over yourself. Election gap's going to be important. You got gravity points. They're important. Then I'm going to pop this up. The two things in here, I can cancel that out. The two things in here, one, this is the trend indicator. This is the daily. Okay, I use it on the 5-minute. I use it on the 15-minute. I just keep an idea where the daily is. We turn green. Again, dots, no dots. Be careful trying to trade off the daily. But when the swings are there, like here was a great one. When the swing goes from red to green on the trend with no dots, and then the dots come in, all the dots are telling you is tighten up your stops. We might be near exhaustion. We're not at exhaustion, but we might be near exhaustion. And look at this. We had this huge 1 day, 2 day, and then all of a sudden, look at the candle bodies. Smaller, 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 smaller. We got dots. And then what happens? As soon as we turn red, flush. And we had that big drop. So the dots are only telling you, just tighten up your stops. Now, Momo, bigger indicator, more important for the daily, for the swing traders, for the investors, your IRA, your 401k, those kind of things that you're not day trading. The Momo for our members, we got a bunch of new members in here tonight, but you just got to know it's just an oscillator, right? If we're below the green line, we're oversold. Okay? When do you buy? Do you want to buy when the fast line, the blue line gets above the green, or when the white? I don't know. You want to buy on this day or this day? I don't know. But guess what? This day's Friday. This day's Monday. You're happy as shit on Tuesday. Why? Because you follow the stupid little oscillator. Now, is that everything? No. But can it help you? Absolutely. Now, with the Momo, this is a daily indicator. Guys, do not go down to a 15-minute and try to day trade off. I don't know what it was there. Don't go and try and day trade off a momentum oscillator. Now, here's the beautiful part of this thing that we've built in. I've built in, had it for years. Like literally, guys, this is how stupid this is. This is 2005 stuff. And if you go through Twitter and my Twitter folks, and you go through and you find all the guys that are in their 60s and 70s, this is all the shit we used to use. We didn't have anything else. There were no back tests back then. However, so this momentum indicator is these dots are the weekly oversold, overbought. So in this case, right here, perfect example is that we go back to October. We got overbought. Blue and white are both above the red. We're in an overbought territory on the daily. We're also overbought on the weekly. And that's what these red dots mean. We are overbought on the weekly. Now, when a market gets overbought, can it stay overbought? Well, it dang sure did here. This is a perfect example of the market mean reverted through time. Overbought here. Move forward 3 weeks, and we're still at the same price. And then the weekly came off. And as soon as the weekly overbought came off, and the daily fixed, and then the daily started jumping, look at what happened. The daily started jumping here on a Monday, here on a Tuesday, and look at where we were on Wednesday, Thursday, and Friday. Happier than a pig in, you know what? Shit, I'll say it. I don't even care. Because it's a saying. I'm not cussing. That's just a saying. That's just looking at oscillator. Did it work here? If you waited, it worked here. Did it work here? If you waited, it worked here. Where are we now? Well, blue is crossing. White's still below it. Are you going to be patient and wait? You say you are. Tomorrow morning, as soon as you guys see a 8.5 point move higher in SPX, you'll be longing quicker than you know what. And again, it's not ready yet. Now, is this your only indicator? No, not at all. Not at all. But your job is to go through and say, hey, if we're below weekly demand, the bottom big white line, I'm leaning short. If you're above weekly supply, I'm leaning long. If we're in the middle, then you know Case and Moose are making tens of thousands of dollars selling theta. Okay, if we get above weekly supply, we're going to run back to these gravity points. So you got gravity points, you got momentum indicator, and you got MOMO, or the trend indicator, and all three of them are pointed that if we can clear the 50-day moving average, and we can start working up into this candle body right here, 59.71, this candle 59.70, up to the top, last week's supply, 6,000. Again, everyone is so horny for those 20 points that they get in, they get shook out, they get stopped out, they get in again, they get stopped out, they get frustrated, they quit, and then the next thing you know, we go above 6,000 and we run all the way to 60.50, and those 50 points are going to be the easiest points of the week. Or the market starts higher and we fall off and we come down and we close this gap, and you buy and you buy and you buy right here, and there's blood in the streets, there's blood coming out your fucking eardrums, and you buy anyways, or you sell puts, and boom, as soon as we bounce, you turn out, you're like, oh man, I'm cool as a cucumber. Knowing that your sphincter was literally, had your knees and was halfway to your nipples. That's how the market is. If we get above here, then I'm leaning long. Weekly supply demand, it's like gravity, guys. It's not just a good idea. When we get below the amount, look at this. Monday, Tuesday, Wednesday, we're testing the top of it. What do? Thursday, Friday, we rip. Here, we don't get above it. We test below it. We test it. We test below it. And then what do we do on Friday? We gap down. How about here? Monday, Tuesday, we get above weekly supply. Which way are we leaning above weekly supply? Long. If you're long Tuesday, above weekly supply, fixing an oversold situation, that is long call. That was a stupid election. So let's not even count it. I mean, get over here. Weekly supply, weekly supply, weekly supply. We never touch demand. And look at the market correcting. Are we overbought? Yes, it showed we're overbought. Daily don't give a truck. Daily's a honey badger. It don't care about the weekly. It tells the weekly, shut up, old man. Sit down in the corner. You don't matter anymore. This ain't the 1970s. And so just get in the process of doing that. Now let's switch to, same thing. Here are the gravity points. I'm going to take them off. We don't need them anymore. They're already on there. Here's our weekly supply and demand. I'm going to take them off. They don't mean anything anymore. What else we got here? The short calls, JP Morgan's collars, market structure. Here's the call for February, right? That rolled at the beginning of December. Here's the big one that just rolled at the end of December. This is the biggest contract. That's why it's bold line, and heavy. Here's the front month. This is the end of this month. So we have 3 short calls for JP Morgan to the upside. I still have the election gap here. And then we have long puts. So when you start looking at long puts at the end of February, JP Morgan is hedging their portfolio because their portfolio is in drawdown if we get below 5,700. Oh, you guys got to tell me if you hear my tick strikes. Okay, then we got these green trend line. Again, a trend line all the way back from August of 23. We tested it. We tested it with a trend line. Again, the YouTube folks will be like, what's he talking about? Here's the deal, guys. If you don't have 3 touches in a trend line, it don't count. So like right here, and this is just a channel. That's all that trend line is that I've drawn. Is it? No. You got to do Fibonacci. You got to do a lot of stuff. Here's a trend line that we did from the April lows, and we matched it at the August lows. And it lines up with the trend line that was coming from all the way from 2022. That's the green. From October 2022, the bottom of the market, right? We called the bottom of the market on October 9th. We went down for another 6 days, and then we haven't looked back. How smart was I October, December? Great, until January when I thought we were done, and then January 23, I started closing out trades. So I made a lot of money, but I missed out on millions. But that's just me. Hey, I'm an idiot, man. I'm a product of the public school system in Alabama. We were like 48th out of 50th. Thank God for Mississippi right next door. That's the only reason we're never last. Okay, here's a trend line. Potential. Blue. We ain't got another touch. Now, are we going to get another touch? We could if the market sold off. But this trend line is not a steep trend line. So we might not see this puppy until April, March, April, May. You never know. I just put it on there to have on there and talk about it. Then we're going to go through and we're going to talk about the inflection points. And I've updated these. So these 3, okay, this last year, 2024, we hit an inflection point in August. This was the only time the entire year we hit an inflection point. We usually hit these inflection points 5 to 7 times a year. 5 to 7 times a year. We only hit 1 inflection point this year. Bob and I were talking about it. To a point where it makes you kind of start to second guess. You know, was the markets really that strong, or was the read really that bad? You know, do I need to change how we factor in the inflection points and all that stuff? No, it's just happening. And then you start looking and you start watching December and January collars, the long puts for JP Morgan, is that if we get to this inflection point, they still don't need this. This is their hedge, right? When the market goes below these lines, this is when JP Morgan's got to hedge a big chunk of their portfolio. So do you think they're going to defend down here? Absolutely. Could we flush through this one pretty quick? Yeah. And if you look at this long put and you look at this green trend line, it's right at 57.12. And look at the date. It's right at Tuesday the 14th. That's in front of MOPEX. That's a week from Tuesday. Could we be down here? Yep. And underneath here is where all these bulls up here are trapped. Now, there's a good chance we'll come down and fill this one and then push back up here and probably going to make a new high. And if you look at the green channel, look at the short call in JP Morgan, and it matches the green channel. Well, that says Thursday the 16th of January, we could run all the way up to 63.50. We ain't going there, and we aren't going down here. We could potentially go down here next week, but you're gonna notice this. So don't buy a put debit spread for this next week. Could you buy a put debit spread for 5,700 March? Yeah, possibly. But if the market pushes down and it responds off this gap fill, you better take profit because the market's going to rally back up. Now, the other thing I got on here is I do a yearly volume profile. And so this is just the last 250 days of the market. But when you start looking at the volume profile and then you look at how it matches up with gravity points, here's our point of control for the last year, down at 54.69. Call it 54.70. Here's our inflection point. Here's our February long put on the collar, along with a trend line. So this is my point of emphasis that I'm most interested in a portfolio. Excuse me. It also lines up with a high value node right here. So we've got a volume node here that's important, right? Someone right in front of the election said, this is as low as you're going to go. February, JP Morgan at the end of December at the end of November, they rolled their February collar to this point. High volume node, market stopped, so we got a swing low in the market, structure in the market, and we got JP Morgan's long put, and we got a trend line all the way back from October 22. We got a lot of stuff down here at 57.10. So if 57.10 does fail, then we're looking at 56, probably 56.60, and then 56.20, and then 55.80, and then the inflection point at 55.55, 55.50. Can it happen? Not tomorrow. Could it potentially? Yeah. So I just got if-then setup. If we don't bounce when we close this gap, then we're going to run down and test the collar. If we bounce when we test the election gap or close it, if we bounce, then we're going to go up to the short collar. Those are your if-then statements for the market for the next 2 weeks through January MOPEX. If we fail this, then we're going down here. If we bounce off this, then we're going up here. What if we go up here first and we go to 6,000, 6,100? Maybe we run to 61.65 in the next 2 weeks. And we never close this gap. Well, the higher we go, the more important that gap's going to be, right? If you build and you leave out some rebar in your foundation and you build a one-story house, you're okay. You get in the second story and it gets a little shaky. You start getting up to the fourth and the fifth story apartment complex and you fail to pour a good foundation, your shit's in trouble. And that's the market. And that's why the market always wants to go back and close gaps, to be efficient, to get back and re-auction through areas where the market goes through so fast, right? The market moved through this zone, and it's hard to see. Let me close all this. It's hard to see, but the market moved through this area so fast that it just left a huge void. This is an island. We had an island reversal. Gap down on the 31st. Chop, chop, chop. Gap open and never came back and refilled this gap. This is important. Structurally, this is important. So for everybody that keeps touting all-time highs, and you just, don't get your panties in a wad when they throw out your pacifier, because we come down and we fill this gap. And your ass is long from up here, and you're long from 61.50. And when we fill that gap, if the markets don't respond positive, then the long-only funds are going to start liquidating. The short-only funds are going to start hitting the sell programs. And the market's going to, absolutely, we're going to work down here. Back to the point of control for the last year, right? So have we gone higher? Absolutely. But were there people that got their portfolios crushed here in this 2 week period? We were in the Bahamas. Or no, we were in the Cancun during this time. And again, I told everybody on Monday, this is the day to start to liquidate your 401k and get out. And then, man, 2 weeks later, it was like, get back in. We already had the green line drawn. That was when I drew the blue line because I'm just using major lows, right? April. Why did we stop there in April? Cross between an elephant and a rhino. Hell if I know. But it matters. Why did we stop here in August? That green line? I don't know. But it matters. So this point mattered. That point mattered. So somewhere down here in the future, way out here in the future, this blue line's going to matter. And when it does, I'm going to look smart. I ain't going to be any wealthier, but I'm going to look smart. All right. So that's structure. That's what we're looking for. If-then statements. That's what you do in the market. So we're looking for the market to go up 61.22, 61.25. All-time highs are right at 6,100. Those are our high side. Our put side was down at 52 or 57.34. 57.34 puts us filling that gap completely, but above the JP Morgan collar. So again, is there risk selling the 57.34s? Yeah, probably.
Order filled.
Did y'all hear that? I don't know if my tick strikes come through or not. I'm trading while we're chit-chatting, so. All right, anybody got any questions on that? So that's just the local levels. Here's the first thing I would do for my non-ITG members. You guys need to know. You need to know 60-20. You would be smart to go ahead and grab a call debit spread, a 5-wide call debit spread at 60-20 on ES, and a 5-wide put debit spread at 59.62, 59.60, 59.65. Try to get them for $1.25 for a 5-wide. Right? 5-wide's going to pay out 2-to-1 if we close below there or above there. Now this is a 5-minute, but if I go daily, we lose them. Right? We don't have them, and I don't want to do that anyways. I got this stupid mean reversion. All right, since we've talked again for our members, we're going to try to get this out in the next 2 weeks. And again, all this is this gave us a short signal. Just Keltner channel. It's a system. It's not a simple Keltner channel band. Again, we built this. The one that we went off of, y'all are gonna laugh. 2004. like I'm giving Rick data that's literally a trading system that's 20 years old. It's probably older than some of our members. But we were laughing. But guys, again, if it works, it works. Now, the whole point in this is it gave us a short trade. We stayed inside the bands. We penetrated the bands. We closed back inside the band. It gave us a long trade here. So the first one was what? If you took the worst case short, 518, and you closed it 494. So 18 and 6, 24 NQ points. You took the worst case, the worst price, 491, and you closed here at, no, right here, at 496, 497. 491 to 497, 6 NQ points. That's it. But if you look at it as a whole, they've given you on NQ 2 trades, same time frame on ES, but it gave you 30 NQ points. Now, where does this become important? When you go back to last week and you get this Friday morning, 8:50 Eastern, and you get that PAMP right at 9:30, and then there's a short signal to MR, and that short signal to MR is in over under. And then nothing. And then we go all the way up here, 1155. And you're not sitting here, and I tell everybody this, so I'm not sitting here trying to mean revert a trend up day. You know, and you can replay it. We can go back further. Here's a day. I mean, look at this one. I'm not, again, 6:40 in the morning. Absolutely flush city. I'm not sitting here waiting to MR and get into long trades and go counter trend until this system. And so I sit there and again, NQ went from what? 640 all the way down to 380 before a signal started firing. Well, we were down here. 340. 300 points on the NQ. There was no mean reversion. Again, this is 5 minutes. It just kind of helps me sit on my hands and not be smarter than the system. Now, are they guaranteed? No. We're tracking it, and we're changing up some of the variables. As you can see, this is a, what do you call it? It's a strategy. So it's not just a script for you. It's a strategy so that we can actually pull out the strategy and back test results and tweak it. Right? So that's, again, something kind of exciting to be coming. And then the last thing goes to our OPM. And this is this week. Okay? On the OPM, and I'm going real quick, January 10th, expiration. This is just the algorithm. And again, it doesn't matter. That number's arbitrary. 53 does not matter. It could be 53, 51. It doesn't matter. All you're looking for is, are they close or are they wide? Are they close to each other or are they wide? They're pretty close, which means SPY and QQQ are very fairly priced. There's not one. Now, if SPY was 73 and QQQ was 51, then I would tell everybody, buy QQQ calls and sell SPY puts. Or buy QQQ calls and sell SPY calls. Do a long short. Right? Short the expensive one. That's all the number means. It's relative. So it is a comparison tool. So all we're looking for on QQQ, as I do this every day, I go down and 37 is not half of 51. What's half of 51? 25. So I'm looking for 25 to mark blue. AMD, there's our guy. AMD's 25. Lam Research, 14. Surprisingly, Micron and Super Microcomputer. Those are the 4 cheapest tech stocks. From the call side, are they cheap on the put side as well? Here's AMD. Yep. Here's Lam Research. Yep. Here's Micron and Super Microcomputer. Yep. And then Qualcomm over here is half the value of the QQQ puts, but it's not quite half the value of the calls. You do your own interpolation there. It's just a quick reference guide that if you want to buy calls for this week and you want to play QQQ and you want to put 70 cents in a slot machine for QQQ to go hit 530, which will be the 15 delta, which means you got a 15% chance of being right and you got an 86% chance of being wrong, technically. That's what the delta represents. Probability that we finish at that strike at expiration. So Qs are paying 72. Well, what if I didn't buy Qs and instead I went down here and I bought 47 AMD? That means I still got 37 cents credit. Almost 30 cents credit. Then I could go down here and I could buy a Lam Research. So instead of QQQ, I could buy one AMD and one Lam Research. So if QQQ goes up 1%, I could expect AMD and Lam Research to go up 1% as well. So you look through this, it says it's 2 times the value. So all we look for in this trade is, can I get twice the return per unit of risk, or can I get the same return with only half the risk? That's what blue is telling you. Red, on the other hand, is your sellers. That's where there's an excess in premium. They're going to make you pay. So if QQQ, they make you pay 51, then the PVI, the option pricing model that has computed all the variables, not just these 3 variables. Y'all know there's like 10 variables in this equation that's not shown. But Meta is going to make you pay twice the premiums that QQQ is going to charge you. So Meta has excessive, extreme premium in it. So that doesn't mean you don't want a long Meta. That just means that if you want to go long Meta, then you better trade Meta with a debit spread so that you can mitigate some of the excess premium that the market makers have put in there. Right? It's $1.48. Most people look at this and they're like, well, Meta's $1.48, $1.50 round up on a 630 stock, but Nvidia's 50 cents on a 150 stock, so Meta's cheaper. Meta's $1.50 divided by 600. That's a lot cheaper than 51 divided by 155. Guys, retail don't know shit about option valuation. They look at strike price. And so we don't, again, the call strike and the price for the call strike, yeah, it matters, but the beauty of this comparison tool is that we've looked at same risk, i.e., all of these had an 85% chance of losing money. If they got an 85% chance of losing money because they're 15 delta, then I want to sell the expensive ones, the red ones, and I want to buy the blue ones. So if you're in the business of wheeling a stock, let's say you don't mind wheeling Netflix, right? And you're going to sell one Netflix, which means you got to have what? You got to be able to buy 100 shares at $912, right? That's the first. If that's not you, that's okay. That's just not your strategy. There's plenty other strategies to do here. But if you were to sell Netflix, one contract, 15 delta, get 230. And then take that 230 and go buy an Nvidia, go buy a Google, go buy an Amazon, go buy an Apple, buy a couple AMDs. Well, you could spend 250 and you could end up with 5 or 6 contracts, long 15 delta, so that if the whole market goes up 2%, you're going to get 2% on 60 delta, and you're going to lose 2% on 15 delta. Do the math, guys, you win. Another way to look at it is go down here. Home Depot and Lowe's, they're sister stocks. Home Depot is red, overvalued relative to SPY. Lowe's is white, it's undervalued relative to SPY. So then I look over here. Are the deltas the same? They're pretty close. Could I sell a 57-cent Home Depot and use that premium to buy a Lowe's? You could. Or maybe you could sell 2 Home Depots, $1.14, and buy 3 Lowe's for $1.20. And now you got a 6-cent debit, but you got long 45 delta, short 30 delta. So you got a little debit in there. I like to do them where you get a trade. I wouldn't do it on just the call side. I would want to do it on the whole strangle. So over here, Home Depot is not quite overvalued relative to SPY, but the premiums are higher. So if I were doing a long short, long Lowe's, short Home Depot, I know some of y'all would be like, what the hell is he talking about? Guys, we do this every freaking week. If you're doing that, you're gonna collect 72 cents and 57 cents. That's $1.29. Say $1.30. You're gonna get $1.30 to sell that strangle, and then you're gonna use 97 cents. So about 35-cent differential between Home Depot and Lowe's if you were gonna try and do a long short. Now, would I do a trade just based off OPM? No, but I would take the OPM and then I would go pull up. Home Depot. I don't even know what's on here. But I would go pull up Home Depot. And I would look at the stock and I'd be like, okay, where are the gravity points? Ooh, look at Home Depot. It's right in the middle. Look, there's a gravity point here, and there's a gravity point here. Is A above B above C? No. That's not a trade I necessarily want to hold along. So then I go look at Lowe's. Is Lowe's any different? Waiting. Nope. Lowe's is even worse. So if I saw those, then maybe I'd be like, you know what? I'm going to sell the further Home Depot put, and I'm going to buy the Lowe's put, because Lowe's in a spot where Lowe's is going to go back down here below here. Because we've got C, and if C goes negative, Lowe's is coming way down. And so, again, that's just the system. You're going to have to do your own. I do the data. You have the data in front of you. I hope you guys interpret the data. And I go, okay, we got a question that came in real quick about monthly OPM. And yes, we do. Here I might can. So here's the model. And this, again, Rick did it for me. But here's the model. And so we can now go in. The snapshot is automatic, right? It happens every day at 5:15 after the market closes, after the option market closes and settle. We can go out and pull any expiration we want. We can go pull any delta we want. And then I gotta export it to Excel. And then from Excel, I gotta go through. The color code it's right about 85% of the time. Okay? So just to kind of give everybody an idea. So when we pull up monthly, here's February at 30 delta. So go look at expiration date and then look at the delta. And all the deltas are going to be as close to 30 as they got. Now, you look at this, 22 delta. ExxonMobil just doesn't have, they don't have a lot of strike prices that are in that delta configuration. So is it precise? No. But is it relatively accurate? Yes. Do you need to confirm with Thinkorswim and Interactive Brokers to make sure the pricing's the same? Yes. I cannot get rid of these freaking formulas. And so I apologize. I can't. There's nothing. I mean, I copy it. I copy it from an options data. I copy it and I paste it. I paste it as not as a formula, but it's still I don't know. And again, it's me, guys. I'm one level above a janitor. But when you start looking at going out to February strikes, you look at NVIDIA and you look at Apple. They're cheaper. They have more value in them. They're undervalued relative. This shouldn't be blue, right? So I got to go color code this. Again, I just copied this over before we started. This should be white. But NVIDIA relative to QQQs, 132. NVIDIA calls relative to 132, absolutely. So NVIDIA obviously is going to be one that you probably want to play February, 129, 130, 154, 155. You want to play that strangle long versus holding QQQ strikes. Okay, and so that's option pricing model. So we got PVI, we got market structure with gravity points, Momo on the daily, looking at weekly supply demand zone. There's a hedge sheet that I have for all the people that sell premium, when to hedge, how to hedge. There's guys in Discord right now that are already talking about their trades overnight. Some people already got call debit spreads on ES, I believe, for $1.15, less than $1.30. Again, the market's selling off. We got our long, right? We got a short, profit, long, profit, and now we're right in the middle of this channel. Again, more important for NQ or ES is that we're trading in between weekly sell trigger and weekly buy trigger. When we get above or below them, then we start working towards the big daddies. And even though these look like they're the same distance, this is a slightly different algorithm than these are. And that's why these are bold, and that's why we run all of our statistic analysis and probabilities for the week, or what are the chances we're going to get up here and hit weekly supply or weekly demand. For our non-members, there's a 99.97% probability that SPX will touch weekly supply or weekly demand at some point during the week. 5 times since 2004 or 2002, 5 times we have gapped above it or below it and never came back into the weekly supply demand box. So literally like 5 times in 20 years, 22 years, 5 times, 252 days a year, 20 years, 5 times we have not traded inside the box. So what happens when the market is well below or well above the box on a Monday? You trade back towards it. And again, these are just small little alpha. Now, do you blindly trade back into it? No. You got to build your if-then statements. Right? And here's a really easy if-then statement. Where was the high tonight? NQ. If we go above the high, if we go above ES high, opening 5 minute was the high of the session in ES and NQ, both of them, right? Like your Omar. If we go above the high, then you trade for weekly buy trigger. If we go above 21,545, then you trade for 21,561. Right? Those 15, 16 points, they're automatic. Right? ES 96 up to 99 quarter, those 3 1/4 points, they are almost automatic. Now, could you be long before then? Yeah, you probably will be. If you're long before then and we get up there, should you peel? Should you tighten your stops? Should you take profit? Probably. And you should have some risk. When weekly supply or buy trigger, they're right in the middle of that first harmonic zone. The market's going to chop in between this zone until we break out. And if we break out below it, what do? Look left. Where are we going? Look left. Where was the recent support? Look left. They're just going to go back through Friday and re-auction through some of Friday. Maybe there's some bad structure there. Maybe there's a fair value gap. Maybe there's a huge-ass candle that never got re-auctioned. They got to go back and repaint that candle. We don't know what it is. But if we get above here, then we're going to what? We're going to last week's high. Or last Friday's high at closing. And it's, guys, it doesn't need to be more complex than that. Start to build out your if-then statements. All right, guys, I got to rock and roll. I'll be around. I got to finish up PVI on the individual stocks. Here is our new. We're starting over. I hadn't even posted this yet. I got to go through and make sure the columns are all right. Guys, this was 21 in live in Options Millionaires Discord, 21-22, 92% return on PVI for the year, 115 on 2022, 94 last year, or 23, and then 96% 24. Again, consistent as the day is long. Again, I'm going to build out the total, and then we're going to build out the unhedged where we don't have. But again, the unhedged, maybe there's some fallacy to it because this was Friday, right? So we sold the 59.55 calls on Friday morning. I know they were at $4. I only took 217, 215 credit or 216 credit and then trading comms. But I wasn't going to risk it too much. But I would have done that with the unhedged portfolio. So I'm not sure if there's a better way to track it. It's just basically looking at the total premium received and do we close early? Do we hedge and it takes away some of the premium? That's the difference between the Big Daddy portfolio and the unhedged portfolio. So Newer members, again, I would not start big. 10%, no more than 20% of your buying power. If we have a bad week, you can't get wiped out while you're learning, right? You want to earn while you learn. You shouldn't be doing 5 contracts. 5 contracts, 100 wide is $50,000 at risk. You need to do SPY. You need to do XSP. You need to do 1 contract. You need to do ES. You can plug all of those into the PVI model. And again, we have them, right? The ranges are here. ES, SPY. I don't have XXP, but you can figure it out, right? So it's 1/10 of SPX. But again, you don't need to do a lot. You just need to do enough to get comfortable with the market and a system. Is this be all in all? No. And if we get above weekly supply, then you're only trading long futures because your long futures day trade or hedges for your PVI high. If we're below weekly demand, like we were all last week, then you only trade short futures. You're shorting futures. Why? Because your intraday day trade is a hedge to your position for the week. Our whole thing is, can we make, again, when you go look at this, when you go look at this from last year, look at this, 8.04% return on a month. And this return on a month is based on $100,000 at only $50,000 at risk. If you go to $50,000 portfolio and you're risking 100% of it, these returns are astronomical. Average weekly return on capital is 4.5% a week. That's over 52 weeks, folks. That's no bullshit. This is why I do the data all weeks. All weeks. The blue in here are just weeks where we didn't sell $50,000 because we might have traded ES. We might have traded, again, all these dots towards the end of the year. Started getting a little leery, certainly after the big Labor Day. The Labor Day swoosh wiped some folks out. Again, you look at the unhedged portfolio, and here was Labor Day bust, and then here was the minus 1665, and this minus 1665 was this trade. I think it was this one or this one. One of these 2 weeks was it was this one. We put it on Friday. And I wouldn't have traded that in an unhedged portfolio. We were inside PVI, and it was just a day trade. 5870s, one of them. I think it was this week. But anyway, so all I do is I just go through in the weeks that the unhedged would have lost money or wouldn't have sold those things. I just manually subtract them out. There's probably a better way to keep track of it, again, but this is the process. Again, this last week, sold these on Friday. And again, a 45 wide credit spread was paying, it was paying almost 385 at the open on Friday morning. But there was no way I was selling it. But I looked at Case's models. I looked at Nick's models. We looked at IC Man Strike. We looked at the big 5950 high volume node. And I mean, it was too easy to not trade. So. All right, guys. I know I'm said I'm done, but I'm really done this time. So with that, guys, I am out. I'll try and get everything posted over to Reddit for you guys. But don't ape in, guys. Newer members that are ITG, sell smaller than you expect. Right? Take a lot less than you expect. You got 52 weeks. Earn a little bit of money. $50, $200, $300. Earn a little bit of money and earn while you learn. But guys, you got to learn. And Moose and I and Case were talking about it yesterday morning. If you're not willing to learn and you want to be spoon-fed, your trading career is going to be very short-lived. And the amount of contributors now that have SPX ranges every week, because we've been doing this together for 3.5, 4 years, it's remarkable, but they make the community better. We've got a lot of data to offset each other. a lot of different perspectives. A lot of guys are looking at different things, and there's a lot of collaboration behind it. And that's why typically we're finding people are more and more successful in the guild, because we're working together and not one person can do it all. And we basically have got a 200 to 300 person strong hedge fund, and we're all doing our own research behind the scenes. And I can't even begin to thank the countless amount of members that contribute immensely to our community with all the scripts that people have helped write, all the dialogue, all the documents, all the back testing. I mean, it's uncanny. We got a Delta room, we got a trading room, which is our catch-all, we got a Theta room, and then we got specific rooms from all of that. One for option pricing model, one for PVI, one for our weekly ranges on SPX, one for our daily ranges, and then all our contributor posts. So with that, guys, Happy New Year 2025. Start slow, but we're going to finish strong. That's the most important. Stay in the game. Do not get wiped out. Stay small, build, slowly build, and then recycle your profits. All right, guys, I'm out. Peace.